Welcome back, traders. In part 1, we covered the core concepts behind the New York reversal strategy. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you. We talked about the silver bullet zone, the AMD cycle accumulation, manipulation, and distribution, and 2 different entry styles, conservative and aggressive. But knowing the setup is only half the battle. The reason many traders still lose money isn't because they don't know the strategy, it's because they don't know when to stay out of the market. A setup may look perfect at first glance, but if it doesn't meet all the necessary conditions, it can quickly turn into a losing trade. In this video, we're going one step further. I'll show you how to filter high probability reversal setups, identify the difference between a true New York reversal and an ordinary pullback, and avoid the low-quality trades that trap most retail traders. If you want to turn this strategy into a repeatable trading system instead of just another chart pattern, then you're in the right place. Let's get started. The second technique is aggressive trade entry. For this technique, it will not mark the order block zone or a gap in the fair value zone, but we will look at the price structure like this. First, the price goes down. After that, it goes up. The point where it goes up, it does the job in the right direction, right? Under the right direction, there will be a lot of stop loss. In the smart money concept, we call this group of stop loss liquidity. When we have liquidity, the big companies like to squeeze liquidity. They will push the price back to this trend. That's enough. The shares are all under control. The big companies keep the last round and push the price up to sell it at an expensive price. The point where they push the price up, it will be a return in the silver bullet zone. We will find the time to enter the trade according to the bigger line. The point where we will enter the trade will be at the beginning after the price sweeps liquidity. This area must be in the New York period because the market is very competitive. Let's take a look at the first example. This example, the area where it is intertwined is the silver bullet zone. The price went down first, then it went up. When it came down, we got a trend, right? On the left-hand side, there is liquidity, which is our stop loss. The big line pushed the price down, squashed this liquidity. After squashing, the price went back immediately. The big line sold it at an expensive price. Therefore, the point where we will trade after the liquidity sweep, we can use price action. In this example, I use the trend line. When the price breaks the trend line, we can buy, and the price has a long-term opportunity to be a New York reversal. The second example is the same graph. There is a silver bullet zone. The price has to go back around here. At first, the price came down, trying to bounce many times. Set as an important trend, there is a lot of liquidity, much more than the previous example, which of course, with so much liquidity, he won't let it go. He pushed the price to pass the trend, pushed far enough, but in the end, the price rose up after the liquidity sweep. Therefore, we can find the time to trade since the first period when the price rose up in the upper line. Or if you are not quite sure, wait for the big green candle to appear first and then buy. After buying, the price will have a chance to rise for a long time. This example is a bit special. Look at the left-hand side. The price is trying to go up 2 times, but it can't. Therefore, set it as a negative trend. When the price breaks this negative trend and can stand for a long time, at this point, there is a lot of liquidity. Therefore, the big line will be managed again. The big line pushes the price down to the target. Decide that it will be the second time. Finally, when the price stands up, we can buy more. Therefore, for this example, we get 2 points of profit. A lot of profit in the first period that we bought according to the technique that I gave. And we got profit again by buying from the front. Looking at the situation, there is a chance to continue to be a New York reversal as well. The next example, the third example, looks the same, but there is one point to be careful about. Let's take a look. In the first period, mark the position of the silver bullet first. After that, look at the price in the London period. The price came down to double bottom. Therefore, this area is considered to be a collection of liquidity. In a while, the price will go back to liquidity, but we won't count this area. The reason is because it is too far away from the silver bullet zone. In addition, it also creates a new liquidity zone to make it bigger. Finally, the big line really squashed liquidity during the silver bullet zone. After squashing, we can find the time to buy when the price goes back up above the target. If we follow this example, it's this big green bar. After buying, the price went back down from the bottom to the top during New York. The last example for this clip will be a turn from up to down. Mark the silver bullet zone position. After that, look at the price structure. The first one, the price tried to go up 3 times but couldn't. Therefore, this zone is an important resistance zone. Of course, when we have a resistance zone, we will have liquidity from this stop loss. It's all full. At this point, the big line likes it very much. The big line pushes the price up more than all liquidity. After that, sell it. We will find the time to open the shot by looking at the price action. In this example, there is a beautiful trend line around here. Therefore, when the price closes below the trend line, we can open the shot and hope that the price will continue to fall for a long time. Finally, the price really continues to fall back during the New York again. There is a little bonus for examples that we will not enter the trade. For example, the price also fell back during the silver bullet zone, right? But the shape of the graph does not fit any technique. The price keeps going down. In the end, there is no liquidity sweep. When it doesn't happen, we can't find the time. Therefore, we will not trade aggressively. If we trade profit, we are lucky. It's just a fortune telling. At the same time, on the right-hand side, we will get an order block when the price starts to return. But the market structure shift is still not very clear, and the price did not work back at this order block. When the price does not touch, we will not be able to trade either. Therefore, conservative entry cannot be used either. This kind of graph is often seen. But don't be sad that we can't get on the car or we get off the car. We're waiting for the time that it's beautiful. Let it fit our trend. Both of them are better. All of this is a New York reversal trade. It's a smart money concept technique that fits the right time in trading. There are 2 ways to trade. You can choose according to your own style. Both conservative and aggressive have different advantages and disadvantages. If you have tested with many assets, which one you like, you can use it as a main factor in trading. See you in the next clip. Goodbye. If you have any trading topics you'd like to discuss, just press 2 inches. Comment, I'll clear things up for you.